Welcome to TheoTrade. This is Don Kaufman. August 24th, 2022. We are just seconds after the cash close here on this Wednesday afternoon. The S&P futures finishing up a staggering 12 handles. I mean, look at it. For the most part, the marketplace today did absolutely nothing. We are massively unchanged. And really, all that we saw in today's trading session, markets are skirting the edge, okay, of the lower expected move inside of the SPX. Much more on that here in just a moment. Lots of risk to discuss in the marketplace, and I'm just a little uneasy about the next 2 days of trade, given the fact that you got two major binary announcements. First and foremost, let's bring you a little bit to that here on the calendar. So tomorrow morning, we're going to have ECB minutes. I'm not sure much is going to come out of the ECB minutes. Nevertheless, we've got GDP. That's the first big binary one. When I say binary, I mean, it's a coin flip. Do you know how the market's going to react? Let's say it's wonderful GDP. That could be very, very bad for markets because it's going to imply that the Fed is going to have to get more hawkish. But on the flip side, a bad GDP print could be good. We are in some bizarre times, people. But of course, then on Friday, we get to hear from, well, the man himself. Federal Reserve Chairperson Jerome Powell hits the main stage in, of course, Jackson Hole, which brings us to the question, are you prepared for a Fed Fest on this Friday? Because, again, there's a huge amount of this binary risk kind of accumulating. I'm going to explain exactly what that happens to amount to right here, right now. First and foremost, let us cruise over to charts and just taking a look at what the marketplace did throughout the course of, well, yesterday's trading session and today's trading session. To start there, I'm moving now to the daily chart. And what I wanted to display prior to this Fed Fest, what I wanted to display is this is your expected move for the week. So the central line here, of course, is the start place for the week. We're expecting plus or minus approximately an $82 move. That's $82 moves higher, $82 move lower. Where are we right now? Well, we're on it. We're on the lower edge of the expected move, which makes these binary announcements that much more pivotal, okay, into tomorrow and into Friday, because we all, okay, kind of know, and those of you, I guess, that are in the know, when you're on the lower edge of the expected move, right, that line, and that happens to be the lower edge of the expected move, that, if you will, it's the happy place where risk kind of goes to die. Nevertheless, if we start to actually edge a little bit lower, okay, the entire trading community will have to hedge, okay, with the dynamic of the marketplace. And I can't stress this one enough. So coming into Thursday and Friday, again, we're right on this lower edge of the expected move, which kind of implies, again, Thursday and Friday, we're going to get a lot more what we term gamma risk. So why is there more gamma risk coming into Thursday and Friday? Well, lo and behold, you're coming closer and closer to the options expiration. Now, the SPX has an expiration every single day, but the Friday expiration carries by far and away the most significant weight, meaning that the most open interest, the most volume is always in that Friday expiration. As you come into Thursday and Friday, that gamma risk really starts to explode. Gamma risk is the directional risk incurred really by the dealers, that is the market makers. So you have these market makers that often have to hedge in the dynamics of the market. So if the news announcement comes out tomorrow and the marketplace doesn't necessarily like it, okay, it can slam this marketplace into 2 sigma territory. If you think that the expected move is $82, 2 sigma territory, all of a sudden you start looking at 160-point move down. Okay, I mean, for the most part, market's already down. The market's already effectively just outside the lower edge of the expected move. But again, we're in a really precarious situation because we can snap lower from here. And it's something that, if you look at risk right now, you're like, well, the VIX already reverted back down. You want to see something even crazier? The VVIX, that's the volatility index. The volatility index, it's like this most recent move to the downside. Okay, that never happened. It never happened. And you take this and you look at it and you say, what does this mean? Okay, it means professionals are not offloading risk right now. They haven't seen anything incredibly scary. I think the way to interpret it is, some people will be like, well, there's nothing left to hedge. Everybody's out of positions. You can't believe that. You can't believe it because, listen, the S&Ps are still trading, at 4,145. Yeah, there's been some heavy sell side activity throughout the course of this year, but okay, we ain't home yet. I mean, again, the marketplace, okay, hasn't seen, catastrophic risk to the downside, and there's still, okay, lots of people holding, huge positions out there. Nevertheless, okay, the professional side of trade right now, they're not out there like just actively hedging. And that's a lot of what the VVIX tells us. And I'm going to give you my most, I think, frank thoughts on this one. And this is purely an opinion. I don't like this. I don't like the fact that VVIX, it's the volatility index, and it's indicative of are there a lot of people hedging in VIX options right now? And the answer is nope, there's not. Then I look over at skew, and skew, it's still really low given the fact that all of a sudden the risk is coming back to the marketplace. Does that make me feel warm and fuzzy? No, that one doesn't make me feel warm and fuzzy either. And the reason is I have the belief that a lot of people, okay, and a lot of trading firms, a lot of market makers, they may be relatively exposed. If we were to make, okay, a little bit more of a move down, people could get caught with their pants down. All of a sudden, boom, we're trading, 39, 31 in no time at all. And again, that's just simply an opinion piece. I don't like a marketplace, okay, where you're seeing risk and yet you're not seeing any confirmation of it. It doesn't imply, and I want you guys to understand, just because VVIX is lower, it doesn't imply that we're going to tank. That's not in question. This is not a directional bias on my behalf. That's not, what I'm trying to imply at all. What I am trying to imply is that if we do see some sell side activity, because, hey, okay, lo and behold, listen, it's a Fed-fueled fantasy coming up here in the next, 2 days. And it doesn't matter what Jerome Powell says, it's just how the market and order flow is going to react. And if order flow starts reacting negatively, it can get violent. That's the point that I want to make, is you might see a little violence in trade to the downside should, obviously, should the Fed say something that's a little bit more hawkish to the marketplace. Now, right now, where are we? Kind of stuck between a rock and a hard place. Up here, okay, that gravity point is 42.11. Down here, again, is 39.31. Now, do we have to hit this or this, later in the week? Absolutely not. It does make a lot of sense to see the 42.11 make a reappearance. But as I said, I don't like where we are right now. I don't like it. I don't have to like it. I don't want to like it because we're on the lower edge of expected move, which right there leaves us in a precarious place. Rallying back up, oh, that's easy. But if we do rally back up, again, 42.11 and we're off and done with. The downside move, though, it carries significant, very, very significant risk. I want to actually add just a bit to this because this has been creeping up on us day in and day out, and not enough people are actually mentioning it. Bonds, okay, people, this is getting trend worthy. The bonds, for the most part, have been effectively straight down, which is taking rates, okay, straight up. Okay, if you take a quick glance at this, and I'm actually going to bring up the TNX. TNX, what does it stand for? This is the 10-year Treasury. This is the interest rate. It's back to 3.1%. The reason I'm cautioning you on this, okay, if this 10-year just heads back up, we start hitting like 3.2%, all of a sudden the fear is going to be driven back into, for instance, tech. Tech does not like an interest rate, especially a 10-year, okay, that is on the bid right now. So again, kind of a precarious situation. The last thing I want to leave you with on this evening's video, again, we're heading into binary news announcements. And in these binary announcements, GDP, could be good, could be bad. It won't make a difference. You will not be able to gauge order flow until it's ultimately playing out. So don't try to handicap the move. All you can do is handicap risk reward. Risk reward simply says, like, look, to the upside, okay, to the upside, we could trade back to the 42.11. To the downside right now, we head to the abyss. There's a higher probability that we go to the 42.11. Okay, the lower probability we go into the abyss, but the abyss, it's just a ton of risk out there. If you're going to position yourself prior to these announcements, try to define your risk. Don't get caught naked short in anything right now, because it's going to get hectic. Last but definitely not least, taking a look at the SPX just into the remainder of the week, because there is one really big final standout on this front. Outside of interest rates, outside of VVIX, outside of skew, outside of the fact that volatility has actually fallen in the last couple of days trade, short-term volatility, that's angry. We are back up to a $60 expected move just between now and Friday's expiration. And you go, well, who cares? So what? It's a $60 move. I mean, we saw, $100 move earlier this week. Now, the point that I'm trying to make is the entire week, earlier in the week, this is literally coming into the weekend. We had an $82 move being priced in for the entire week. Okay, here we are. We're already through Wednesday's trade, and we still have a $60 expected move. So this is what I mean by like a binary move. Risk is building, okay, into a little bit of a crescendo into the latter portion of the week. We're on the lower edge of the expected move. Again, risk reward is not equal at this point. And I'm going to leave you with this last thought. That downside, as I say, the abyss, it's big, it's hideous. Upside, probably back to somewhere near, okay, this 42.11. Does that look equivalent? Absolutely not. Keep it in mind, okay, through the remainder of the week. Markets right now, they are on the edge. Be prepared, okay, for the Fed Fest coming later this week. And of course, GDP tomorrow. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.